For decades, getting a loan often depended on your past borrowing history, information gathered by big credit bureaus. But what happens if you're young, an immigrant, a gig worker, or live somewhere without a developed credit system? You might be credit invisible, locked out of financial opportunities simply because the traditional system doesn't have enough data on you. This affects billions globally. Thankfully, there's a shift happening. Lenders are starting to look beyond traditional credit reports, using what's called alternative data. This wider range of information helps build a fuller picture of someone's financial reliability, even without a long borrowing history. So what is this alternative data? Think about things you already do. Paying your utility bills, electricity, water, rent, consistently on time shows responsibility. Your bank account activity, how money flows in and out, your balance, even your spending habits, paints a real-time picture of your financial health. Increasingly, people are giving permission for lenders to access this. Then there's verifying your employment and income, especially important if you don't have a typical 9-to-5 job. Even things like professional licenses or owning property can add to the picture. Some look at e-commerce history too, though using social media data is much trickier due to privacy concerns. Just having this data isn't enough. We need smart ways to analyze it. That's where artificial intelligence and machine learning come in. These advanced computer models are great at sifting through massive amounts of diverse information. They can spot subtle patterns linking things like regular bill payments to creditworthiness, patterns older models might miss. Studies show these AI-powered systems, using alternative data, are often better at predicting who can repay a loan, especially for those underserved groups. They can even help personalize financial products. The biggest win here is financial inclusion. This approach opens doors for potentially billions of people worldwide who were previously shut out of the credit system. It means people can be judged on their current financial responsibility, like paying rent reliably, not just on whether they've borrowed from a bank before. For lenders, it unlocks huge new markets of trustworthy customers. Beyond inclusion, using alternative data provides a more complete, up-to-date view of risk. It can reveal financial stability that traditional scores miss or flag hidden risks sooner. Bank data, especially, gives a very current snapshot. Of course, it's not without challenges. The quality of alternative data can vary. Protecting sensitive personal information is crucial, requiring strong security and clear consent. There's a risk that AI models, if not built carefully, could accidentally reflect or even worsen existing societal biases, so careful design and monitoring are essential. Explaining how a complex AI model reached a decision can be difficult, but it's often legally required. Plus, navigating regulations like fair lending laws takes careful work, and implementing these new systems costs time and money. Despite the hurdles, the move towards using alternative data and AI in credit decisions is growing fast. We'll see more integration with open banking, smarter and fairer AI models, clearer rules, and more partnerships between banks and tech companies. By embracing these new tools, the financial world can become fairer, offering opportunities to many more people, while also making better, more accurate lending decisions. It's about building a more inclusive and precise financial future.